Welcome to the Explainer. Today, we're cracking a very common problem for dividend investors. How do you take a fantastic, high-quality ETF like SCHD and, just give its income stream a little more juice? Well, we're breaking down a practical playbook for building a $50,000 portfolio that does exactly that. All right, let's get into it. If you're an SCHD owner, you know this feeling. You love the quality, you love the super low cost, the dependable growth, but maybe, just maybe, you've looked at that dividend payment and had this exact thought. It's an amazing foundation, but what if you need more cash flow, like right now? That desire for a bit more oomph is the entire reason we're here today. So here's our roadmap, our playbook. We've got 6 parts. We're going to start with the why, the challenge with SCHD's income. Then we'll get to the how, with the core satellite blueprint and the exact portfolio. We'll cover the logic, the good stuff versus the bad stuff, and then we'll wrap it all up with a checklist to make it happen. Okay, let's kick things off with part 1, the SCHD income challenge. And why it's such a rock-solid place to start in the first place. Look, you really can't argue with SCHD's appeal. It has the strict screen for high-quality, sustainable dividend payers, and it does it all for a rock-bottom fee. It's pretty much the definition of a dependable core holding. But, and this is the big but, here's the challenge. Its yield tends to hover around, let's say, 3.75%, which is solid, but it might not be enough cash flow for those of you who are really focused on maximizing your income today. So what's the plan? How do we fix that? Well, we're going to use a core satellite blueprint. The strategy is actually pretty simple. We keep SCHD as that unshakable foundation, but then we surround it with some targeted positions that are specifically chosen to crank up the income. So let's define that properly. The core and satellite strategy is where you put a big chunk of your money, that's the core, into something stable and diversified, like SCHD. Then you use the rest of your money to buy smaller, more focused positions, those are the satellites, to hit very specific goals. And for us, that goal is simple: higher yield. And for our playbook, the structure is a beautifully simple 50-50 split. Half of the portfolio, 50%, stays parked in the safe, quality core of SCHD. The other 50% becomes our income engine, spread across some carefully picked satellites to really boost that cash flow. It gives us this fantastic balance between safety and yield. All right, so what are the actual ingredients here? Let's dive into the nuts and bolts with the portfolio breakdown for a model $50,000 investment. And here it is, the whole lineup. You can see that big $25,000 anchor in SCHD right at the top. The other half is spread across 8 different satellite positions. And just notice the diversity here. We're not just buying more of the same kind of company. We're pulling in income from telecom like Verizon, energy pipelines like EPD and ET, real estate, private credit, even healthcare. Every single piece here has a specific job to do. Okay, so why this particular group of companies? Let's get into the rationale, the recipe, if you will, and see why these satellites work so well together. First up, let's talk telecom and midstream energy. A company like Verizon, a telecom giant, is in here for its steady, utility-like cash flow. People pay their phone bills, right? It's reliable. Then you've got the midstream players, EPD and ET. Think of these guys as operating toll roads for energy. They get paid fees to move molecules from point A to point B, which helps insulate their income from the wild swings of commodity prices. Next, we bring in our real estate and credit engines. We've got Realty Income, famously known as the monthly dividend company, and VCI Properties. They give us predictable rent checks from long-term leases on real assets. And then there's this beast, Aris Capital, or ARCC. It's a powerhouse in the world of private credit. It basically acts like a bank for mid-sized companies, and it generates a very, very high income for our portfolio. And finally, we add some ballast with a healthcare pick, Pfizer. Now, the source calls this a yield plus patience play, which I think is perfect. The stock has been beaten up a bit, and that's pushed its yield way up. So the idea here is that you're getting paid a really nice dividend to wait for the company's new drug pipeline to mature. It adds a defensive income stream that doesn't really move in lockstep with the other sectors. Okay, the portfolio is assembled. So now it's time for part 5, the payoff and the pitfalls. What are the actual results of this strategy? And maybe more importantly, what are the risks we absolutely have to be watching out for? So first, the payoff. The combined portfolio shakes out to an estimated yield of right around 5.1%. That is a huge step up from just holding SCHD by itself.
And here's what that actually looks like in your bank account, in real dollars. A pure SCHD portfolio of this size would get you about $1,875 a year. But by adding our satellites, that number jumps to over $2,500. That's more than a 35% increase in your annual cash flow. I mean, that's a truly meaningful difference.
Now that all sounds fantastic, but every single investment strategy on the planet has risks. So you have to ask yourself, what could go wrong here? Yeah, there's no such thing as a free lunch, so let's be really clear about what you need to monitor. If interest rates suddenly jump higher than expected, that could hurt the REITs and telecoms. There are also long-term regulatory and social risks in sectors like tobacco and healthcare. Those are known factors. A really sharp recession could definitely impact Ares Capital's loan portfolio. And while those midstream companies are pretty insulated, extreme shocks to commodity markets can still affect their business. Which brings us to our final and most practical section, Part 6, your implementation checklist. This is your step-by-step guide for how you could actually go about building this portfolio. Here's a simple 4-step plan. Step 1, fund your core first. Buy the SCHD to anchor the whole thing in quality. Step 2, layer in those satellite positions gradually, maybe in 2 or 3 different purchases to average out your cost. Step 3, and this one is critical, mind the taxes. Understand what you're getting into. And step 4, rebalance, maybe once a year, just to make sure your allocations don't get too out of whack. Let's just double-click on that tax point because it's really important. The midstream holdings, EPD and ET, they're MLPs, so they issue what's called a K-1 form at tax time, which can be a little more complex. At the same time, the income from our REITs and our BDC is typically taxed as ordinary income, which is higher than the qualified dividend rate. This is exactly why you need to think about which type of account, like a taxable brokerage or a retirement account, you use for these specific holdings.
So to wrap it all up, this portfolio is really designed to do 3 things and do them well. First, pay you now, with a whole lot more cash flow than SCHD on its own. Second, stay sturdy by diversifying across completely different kinds of businesses, not just different stocks. And third, remain manageable. It's just 10 total holdings to keep an eye on.
This quote from the source material really just says it all, doesn't it? The entire philosophy is about having that unshakable quality at the core, and then strategically adding these positions around the edges to create a consistently beefier cash flow. The biggest takeaway here is that you don't actually have to choose between the reliability of something like SCHD and the income you need today. A smart satellite lineup can give you the best of both worlds. And that really just leaves us with one final question for you. How could you adapt this playbook to fit your own financial story?